Welcome to the Keiser Report. I'm Max Keiser. The UK's Business Secretary, Vince Cable, has compared the Bank of England to the Taliban and to jihadists. Vince made this comparison not because of their reckless quantitative easing, nor because of their overlooking bank fraud and infinite rehypothecation, that is to say, because they are indeed terrorists. Now, Vince Cable is saying that the Bank of England are jihadis for insisting banks have minimum capital reserves. Vince, oh boy! As I've said for years, the Bank of England are indeed like the Taliban, but only because they provided the safe haven for the jihadis of banking fraud who strapped on the debt-packed suicide vest and blew up the entire frickin' economy. And that same Taliban central bank is now papering over the bloody aftermath with little pieces of digital paper. Now, to explain more, we turn to Stacey Herbert.
Well, Max, first of all, I did look up jihad, and I'm sure the NSA knows I looked it up on Google. And the definition provided by Google was that it's a war or struggle against unbelievers. So this is important for the rest of this episode, this notion of unbelievers, which I think we should reterm for the West as disbelievers. Nobody believes their lies and fraud anymore. Vince Cable calls Bank of England capital Taliban. Vince Cable has stirred tensions within the Bank of England by apparently comparing policymakers to the Taliban over restrictions imposed upon banks.
Well, first of all, let me say something, which is that I coined the term financial terrorist. Now, here comes Vince Cable glomming onto my poetic characterization of the Bank of England and all the banks in the UK as financial terrorists by creating this term of capital jihadists. But of course, he's misapplying that term. The banks, of course, they would need capital reserve requirements to be functioning banks in a free market system. You don't want banks involved in Ponzi scheme economics like Vince Cable is proposing, like Vince Cable is perpetrating, like Vince Cable is supporting by saying, no, we don't want minimum capital requirements for banks. We want financial terrorism. So Vince Cable now has become financial terrorist number one. It used to be George Osborne, but now Vince Cable. You're financial terrorist number one. You've earned that right for stealing my material without attribution. That right there is a copyright violation, schmuck.
Well, he's comparing them to the Taliban, capital Taliban. So basically, here's the Bank of England, and you could look back for 300 years of their interest rate policy. Their money, their capital policies are looser than they ever been. This is the equivalent of a woman walking down the street with a G-string and pasties on, and he's saying that that the Bank of England is treating the money as if it has a full-clad burqa on and hiding the money, keeping the money from flowing loosely around the economy. He's blaming them for these capital requirements, despite having ultra loose monetary policy.
Right, well, that brings up the question, would you rather see Vince Cable wearing pasties on his nipples or a burqa? And I think I'd rather see Vince Cable wear a burqa. But that doesn't mean that his characterization of the minimum capital requirements is correct by referring to these people as capital jihadis.
Yeah.
Okay, Vince Cable as a pasty-wearing capitalist terrorist slash financial enabler of the City of London to rehypothecate what non-assets they have to even greater levels of Ponzi nirvana is now on the table. In other words, he's revealed himself. He has shown his true colors, Vince Cable, as being this financial terrorist who promotes Ponzi schemes.
Let's roll back a little bit to say exactly what's happening here. So the Bank of England's Prudential Regulation Authority, the PRA, has ordered Britain's 5 biggest lenders to raise £13.4 billion to plug a £27.1 billion gap in their finances. So George Osborne is also agreeing with Vince Cable here. He refers to the jihadist tendency in Threadneedle Street. And this is despite this puny amount, $27.1 billion, that we've had the funding for lending scheme. All of that money did not go to small businesses. In fact, investment is down by 30%. They're only lending to these Ponzi schemes, to housing. Every single freaking penny you give these people, they just go into the speculative Ponzi scheme here. And in terms of this money, here's the £27.1 billion gap. You know, Apple has just reported almost $150 billion cash and bonds just sitting on their balance sheet. There's too much cash in the world. There's trillions sitting on these corporate balance sheets. Why are they not putting it to work if there's such a great economy out here?
Right. Well, to get into this specifics of what's going on here with this call that banks should be looser with their minimum capital reserves. You know, Osborne brought in this funding for lending, and then he brought in the Help to Buy scheme, which is to get people to speculate in the housing market again. And then Nationwide, one of the banks, they said that, well, we can't do both. We can't have the lending scheme that you're proposing and have minimal capital requirements because we're already breaching that 3% level. And so this is what triggered Cable and Osborne to go after the regulators and saying, and Mervyn King, the outgoing Bank of England head, saying, look, we have to allow these banks to reduce their minimum capital requirements, inviting another catastrophe as we saw in 2008. And who's going to be on their side but the new Bank of England head, Mark Carney, who is going to be, you know, pulled into this scheme. And what it means is print, print, print by the Bank of England. It's going to have more inflationary pressure right now. Inflation's on a tear in the UK. It's 3.1%, you know, that the government says, but it's actually 8%, 9% unofficially. So you're going to see that continue to race ahead. Living standards continue to collapse, and the housing market will reach the point of a bubble and then collapse.
Again, this is our form of jihad here. It's a war on disbelievers. So they're angry that we don't believe their lies, that they're telling us lies. We know the economy is crashing. We know wages are down. And so what's supporting these house prices rising? Where are the jobs? Where is the real income? Where is the real wealth creation?
Yeah, what? Vince Cable is calling me an infidel because I don't believe in his Ponzi economics. I would return it and say, Vince Cable, you're apostate, which means that you've turned your back on free market capitalism. You're a frickin' welfare socialist bum queen who's out there sucking on the teeth of the state and the Bank of England with free money. That you're a bum. You're not even apostate. You're not even worthy of that phrase. You're just a bum in the street begging for money.
So, you know, and now we'll go on to the next story here about disbelievers, because a recent study has shown that our artificial intelligence, computer algorithms, have about the intelligence of a 4-year-old. And part of the reason why they're not smarter yet is that they don't have common sense. They can't tell basically a lie. They can only take the data and the facts, historical correlations, historical data, and determine where things are going to go. So in terms of this war on disbelievers that the central banks are engaged in, humans beating robots most since '08 as trends shift currencies. So this is in the Forex trading markets, and humans are proving more adept than computers in reacting to the Federal Reserve's mixed messages, i.e. lies, on when policymakers will reduce their unprecedented stimulus. So at the moment, most Forex trading is done via algorithms, but the few that are done by humans are actually outperforming the algorithmic trading on currencies because they're looking at historical data and trends and what should normally happen, and it's not happening.
I'll tell you what's going on here. The computers were generating returns that were consistent with market conditions and consistent with inflation trends and consistent with interest rate policies. And those returns were not sufficient enough to cover the extraordinary malfeasance that people like Vince Cable is encouraging. So what the humans have done is they are basically rigging markets to confuse the machines and saying we're outperforming the machines based on our own rigging and trading on inside information. And somehow this has turned into a story that humans are now beating the machines. No, humans are unplugging the machines because the machines were telegraphing the fact that the humans were rigging the markets. So now they're saying, well, let's unplug them because it's offering too much transparency on what Vince Cable wants us to do, which is to rig markets, manipulate markets, and to commit fraud.
Well, Richard Olson from Zurich is quoted in this, and he's the founder of Olson Limited, who has designed currency trading models since 1986. And he says about what's going on in the Forex markets at the moment, central banks have become the insider traders of the currency market, which is a paradigm shift that systematic traders cannot pick up as well as fundamental traders. Systematic traders are the algorithmic trading, the robots.
In other words, the NSA and all of the surveillance technology made it very difficult to beat the markets and generate any kind of alpha or in your portfolio because all of the differentials between market pricing had been arbitraged away through these sophisticated computers. And so the returns from these algorithmic computing programs were not sufficient enough to pay the interest on the yacht that I just bought. If I just paid $200 million for a yacht, and I need to generate a certain amount of return manipulating markets, I can't have some computer that's going to efficiently arbitrage away all the fraud, get in the way of those yacht payments. So I'm going to blame the computer, unplug the computer, manipulate markets more, convince Vince Cable and Mark Carney and George Osborne to commit more fraud than they already are doing so that I don't miss my yacht payment.
Again, we go back to this fact that there's a breakdown of long-held correlations, i.e. the disbelieving. So, you know, you should be able to enter in the algorithmic trading, the data, the facts, what would normally happen in a supply and demand situation. But none of those work anymore, plus the central bankers are lying. So when Ben Bernanke said that he's going to taper, the computers lost because they didn't expect that. They weren't anticipating that based on the data of unemployment and inflation and other numbers. So they've lost in there. And that's the important thing to look at here of what happens with central bankers. So when Vince Cable is saying that this is a problem of the central bank not of demanding the banks commit more fraud, because that's what he's saying, because this is all they're engaged in at this moment, of lending fraudulently based on collateral that doesn't really exist. That the breakdown of this data has resulted in long-held asset correlations is proving problematic. We're going to take your savings, we're going to confiscate your savings, we're going to bail in you if you continue to disbelieve our lies.
Scary. All right, Stacey Herbert, it's all clear. Thanks for being on the Keiser Report.
Thank you, Max.
Okay, stay tuned for the second half. A whole lot more. Welcome back to the Keiser Report. I'm Max Keiser. Time now to turn to Alistair McLeod of goldmoney.com. Alistair, welcome back to the Keiser Report.
It's my pleasure, Max.
All right, now, Alistair, you have late breaking news, an exclusive report, really powerful, explosive information pertaining to the gold market, but I don't want to get there quite yet. I want to kind of review some of these other things that have been going on and give some background. Then we'll get into this explosive revelation that you have. Now, in the news this past week, we've heard a couple of terms, backwardation and GOFO, in the gold markets and the gold leasing markets, et cetera. Backwardation, we've talked about in this show before. It's very rare in markets to have the short-term trading at a premium to the 3 or 6 month price. It's in backwardation. That's what that means.
It indicates a shortage of physical metal for spot delivery. Yeah.
Okay. Now, GOFO, we've heard this a few times in the last week. Dig into that. What is GOFO?
Well, GOFO is the gold forward rate, and you compare GOFO with LIBOR. Now, normally what happens is that GOFO is less than LIBOR, because what the central banks do is they lease out gold, bullion banks take that leased gold, they sell it into the market, and they take the proceeds and they lend it back to the government, usually for an interest rate turn. So under those circumstances, which are normal, GOFO is less than LIBOR. We have a situation now where for the last fortnight, GOFO has been higher than LIBOR, which has turned the world on its head. Now, we don't necessarily know what this means, and it is more likely to happen when LIBOR is very low, obviously. But what it is indicating, I believe, is that there is now a slowing down of the provision of gold for leasing by the central banks. So I think it's indicating a tightness, if you like, in terms of supply. So the next question that goes on from that is that if central banks were quite happy to lease bullion into the market or into the bullion banks before, why are they slowing down now?
Okay.
I leave that hanging, as it were.
But both of these indicators, these you could look at, the barometric pressure or the temperature. These are gauges to assess what's happening in the internal machinations of a market.
Precisely.
And these two very key indicators are both indicating tightness in supply.
They're flashing red. And not only that, but if you look at the delivery situation on COMEX, that is also flashing red.
Okay, I can't wait. What, really? Tell us more.
Well, it's because the amount of gold actually held in the COMEX depositories is extremely low. The amount of gold which is registered for delivery into the market, in other words, dealers' gold, is incredibly low. And so far as we can see, a lot of the May settlements haven't actually been cleared yet. And that's only looking at the day-to-day drawdowns, if you like, out of the bullion banks.
Now, I was just reading some comments by Jim Sinclair, who's one of the deans of in the gold business, I would say.
Yes.
He's saying that COMEX is going to have to flip to all cash delivery, and they're just simply say we don't have the gold, we can't deliver the gold. There's too leveraged. There's a run on the gold markets. We can't deliver. We're going to go to cash, and that this will cause a panic in the market because people will realize then that there is no gold available. Your thoughts on
this? Yes, I suspect that this it's the delivery situation in COMEX that Jim Sinclair is really thinking about, that he's got in the back of his mind. I think he sees a crisis coming. I don't want to put words in his mouth, but that would certainly make sense if that was what he was seeing, and then extrapolating from there what is likely to happen. And as you say, he's a man of great experience. So we listen to what he says. Right.
There would be a panic buying in gold. People realizing that the paper claims that they hold are worthless. And suddenly, why is it worthless? Is because there's less gold around than they thought that they had. And so then, because there's less supply and there's high demand,
understand the underlying dynamics. They are in the situation now where they are beginning to close their positions, and we saw this on the last Commitment of Trader report. The outstanding shorts came down a bit, but it's still incredibly high. So what we're seeing are the early stages of a wonderful bear squeeze.
Right. When you say closed
bull, I love bear squeezes.
When you say closed positions, you mean closed short positions.
Exactly. Closed short positions. They have got to buy it back.
To buy it back to close that position.
Exactly. And they've got to find someone to buy it from. And the point I'm putting to you is that unless the bullion banks are prepared to accommodate them, and they're not very friendly people, the bullion banks, then there is no one to sell the stock back to the shorts.
Let's move on to the late-breaking news of the day. This is ground-shaking stuff. Okay. Bank of England, according to some information that you've looked through, we've got some incredible information here. I'm going to throw it to you to break this news. Tell us some details here.
Okay. Well, not so long ago, I had a call from a journalist friend who told me, Alistair, have you seen the new app on the Bank of England website? I said, no, I haven't. He said, well, perhaps you ought to look at it because it's got some interesting things in it. And part of the app is a tour of the whole bank. It gives you a tour around the gold vaults. And there are various sort of factoids. I think there are about 12 different sort of factoids, a horrid word, but anyway. And one of them is that, and this is dated June, so it's very, very recent. This has only just gone up. One of them states that in storage, in custody, in the Bank of England, there are over 400,000 400-ounce bars. So I looked at this and thought, this is slightly different from the year-end figure, which is shown in the annual report, which translated into 400-ounce bars is actually 505,000 bars. So, ergo, roughly 100,000 bars seems to have disappeared from the 28th of February, when the annual report was dated, and sometime in June. So, where has this gold gone? Now, bearing in mind that post-Cyprus, there was a huge, great increase in demand for gold as people tried to take demand of physical in Europe, as China and India were ratcheting up their buying, there was this, and it was clearly a coordinated attempt to take the bullishness, to take the steam out of the market. And it started with a hit on COMEX, and that got all the stop losses triggered and so on and so forth. It got people selling ETFs, so that created a supply. The common thought is that this supply was sufficient to keep the price down. But if you do the sums, no, it is not. There is a huge shortage of bullion, so it must have been being supplied by a very big dealer. Okay. Now this, I think, is where that 100,000 400-ounce bars has gone, which is roughly 1,300 tons. Now that would make sense. It's the sort of number which I would expect to keep the price suppressed over those 2 or 3 months.
You're saying, you're confirming that Bank of England is 100,000 ounces short.
No, 100,000 400-ounce bars.
1,300 tons.
1,300 tons.
1,300 tons. You're confirming that the Bank of England, and now Bank of England, of course, was already bailed out Goldman Sachs under Gordon Brown when they dumped 300 tons.
So they say.
So they say. Okay. So they've already been involved in a scandal. And
well, the Bank of England has always had a management position in the London bullion market. Of that, there is no doubt at all. And the Bank of England, if you look back through the archives...
Wait a minute, Al, sir. You're saying 1,300 tons?
1,300 tons, yes.
Okay, so they would also, that means that they would be in a position that they have sold gold that is not actually owned by the sovereign state of Britain.
We've only got 310 tons.
Right?
Yeah, exactly. But the
so when Germany says, we want our gold back, but they're saying, no, we'll give it to you in 7 years? Is it because they sold their gold? They're sold all these other countries' gold?
No, hold on a minute. We used to, the Bank of England, again, this is all in their accounts going all the way back, used to run sight accounts. In other words, bullion held for other banks, other central banks, was on the balance sheet. That was run off around about 2005, and 2006 was the first year when they started declaring outside the accounts that gold held in custody was a figure, and they gave you a value figure, and you could work out from there with the cable rate and with the price of gold at the 28th of February, which is always the date of the accounts, exactly how much gold they held. So that's absolutely fine. So the Bank of England actually is now in the business of fixing leasing contracts for central banks, other central banks. They are literally an agent, if you like, between other central banks and the market. Now, we know from something that the Austrian central bank said in an unguarded moment that, yes, they've been leasing gold into the market and it helped pay for the storage costs. Hold on a minute. They then withdrew that because they knew that they'd said too much. But I also remember the Bundesbank saying that the reason they withdrew gold from London, I think this was back in about 2000 or thereabouts, was because the leasing expenses were, the storage expenses were too high, and therefore they took some of their gold back to the Bundesbank. So it seems to me, and I may be wrong on this, that the Bank of England has a policy of charging storage fees which are expensive. And then when a central bank complains, turning around and say, well, there's an easy way around this. Why don't we lease your gold into the market and make it work for you, and that will pay for the storage costs? Right. And I think that's the general approach.
But if the countries that have been bailing themselves to this service ask for the gold back, the Central Bank of England will have to go and buy it in the open market.
Well, no, what happens is the Bank of England says, well, you've leased it, and when the lease is ended, then hopefully you'll get it back. Perhaps, knowing that in current circumstances it's now worn around the necks of various Chinese and Indian women. But
yeah, well, that's what they're saying. The demand in the East is huge, and so essentially the bank held in the West has gone into the East. But I would just point out that this is based on a preliminary look at the website, an app on the web. These are not audited figures. This is based on.
Well, let's go into that a little bit more. I mean,
and we have about 20 seconds.
It's such a definite statement that here we have over 400,000 400-ounce bars, compared with 505,000 400-ounce bars literally 4 months earlier. Now, that to me is a significant difference, and I don't think that it's just, you know, someone getting muddled and not quite saying quite the right figure. The Bank of England doesn't do that. And I think that, therefore, we need to take notice that it's now over 400,000, not over 500,000 400-ounce bars. The difference being 1,300 tons of gold, which I guess is roughly what would have had to have been supplied into the market to try and keep the price down with all the Indian demand and the Chinese demand. And of course, the next thing they're doing is they're leaning on the Indians to try and restrict importation of gold, as you may have heard.
All right, fascinating. We're out of time. Thanks for this late breaking news, the exclusive here on the Keiser Report with Alistair MacLeod. Thanks for being on the Keiser Report.
That's my pleasure.
Okay, that's all the time we have for this episode of the Keiser Report with me, Max Keiser, and Stacey Herbert. I'd like to thank our guest, Alistair MacLeod of goldmoney.com. If you'd like to get in touch, tweet us at Keiser Report. Until next time, Max Keiser saying bye, y'all.